Happy Monday, traders. Okay, with the end of the geopolitical crisis in the Middle East, markets are trading a lot calmer, and we saw a quiet end to trading at the end of the week. But markets are obviously trading risk on, trading bullish, and the biggest beneficiary of the geopolitical crisis endings obviously has been equities and US equities, new record highs being printed there. Look, they are in a sweet spot at the moment, and it'd be very hard to find a reason at the moment to see a decent retracement or a reason to sell equities. Equities at the moment really aren't scared of anything. And obviously, if we did see a retracement, look, the dip buys would be there. And it seems as if now we are seeing a bit of FOMO, fear of missing out, entering into the market. A very interesting fact for July, seasonality for July for US equities is very positive. For the last 10 years, US equities in July have had a positive month, and the average return for the S&P has been around about 3.5% for July. So if we put 3.5% for where S&P is trading at the moment, that is another 200 points higher for July. So, targets up towards 6,400. So yes, I would not be selling US equities at the moment, even just on the back of this seasonality, which is exceptionally strong. Look, one market though that has, I suppose, seen some volatility is gold. Gold did see a decent sell-off end of last week. We went down from around 33.30 all the way down to 32.50. And obviously one of the things that's still happening in gold at the moment is, the market is getting rid of that, the war premium that was built in, the safe haven flows are moving out of gold. End of last week when we did the market update, so the new range for gold is probably around that 32.50, 33.50. Now we are testing the lower end of that range at the moment. There are obviously buyers there because it has stalled the gold sell-off. If we do break that, obviously, then I'd imagine the new range for gold was probably around 3,200 up to 3,300. But certainly not a one-way bet anymore, a lot of two-way flows in gold. As far as the currency space is concerned, market is still very happy selling US dollars, so the trend certainly is money's been made short USD. It is a very popular trade, and I guess when we do have very popular trades, there is a risk that we can get a violent retracement, so that is something to watch out for. One of the things that I do like is being long risk currencies. Aussie is the premier risk currency globally. If we go back to seasonality in July for US equities, if we see S&P go anywhere near that 6,400, up 3.5% in July, Aussie will not be sitting here just over 65 cents, 65.30 where it is at the moment. I imagine that it would be well above 66 and maybe pushing 67 cents. So I would not be selling Aussie and basically long Aussie bias for July. Okay, so this week not a lot as far as risk events, but there is some important economic data coming out this week. Tomorrow, Tuesday, we do get some Eurozone inflation numbers in May. We did see headline inflation dip down to 1.9%. We have had a lot of ECB rate cuts. Market is not pricing in any more ECB rate cuts for the end of the year. If for whatever reason we did see a number that came out below expectations, potentially the market might start thinking the ECB might even go another time. That might be the only thing that might be at the moment that might worry euro, which has obviously been on a tear and it's trading above 117. So the CPI number tomorrow is going to be important. On Thursday, we do have Swiss CPI. Why is that important? It's because the Swiss in the last number was actually, we had a negative CPI number. We've got deflation happening in Switzerland. The SMB did cut down to zero, lowest cash rate, policy rate globally. So market will be watching to see if that continues at deflation. If it does, potentially market will start pricing in the SMB going back to negative rates. But the S&P's next meeting is in September, so they do have a couple of inflation prints that they can still look at before that happens. On Thursday also we have non-farm payrolls. It's on Thursday this week, one day early. Because on Friday we do have a holiday in the US, it's 4th of July, Independence Day. Now, non-farm payrolls are always one of the biggest numbers out of the US for the market. This one will be closely watched. Headlines expect around about 121,000. Unemployment rate to stay around that 4.2%. But if this number does come out below expectations, then the market will start looking at the July FOMC as live, and that potentially the Fed could cut. At the moment, market's pricing in around about a 16% chance. So, it's a small chance, but that would certainly, the chorus will grow. No doubt Trump will be all over Powell, tweeting like crazy, saying that he needs to cut immediately. There'll be a lot of political pressure, but again, Thursday is going to be the main game for markets, no doubt, with what happens with this non-farm payrolls print. Good luck with the trading to start the week, and we will catch back in with you soon.